Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
Clients and accountants regularly discuss the subjects of associated companies and corporation tax rates. Over the years, we have seen changes in the definition of associated companies, with the most recent adjustments coming into force on the 1st of April 2023. This occurred simultaneously with an increase in the primary corporation tax rate from 19% to 25%. On the surface, the associated company changes may seem pretty innocuous, but as ever, the devil is always in the details. Let's look at the changes brought in by the government and the potential impact on company profits and cash flow. What is an associated company? In the past, there were opportunities to split business operations into different companies owned/controlled by the same individual/groups to reduce corporation tax. Then we saw the introduction of the Associated Company rules, which were significantly revamped on the 1st of April 2023. As part of these changes, the previous 51% group company test was removed and replaced by Associated Company rules, similar to the situation before the 51% rule was introduced. Broadly speaking, companies are associated if one company has control of the other, both companies are under the control of one person/group of people. Before we look at the new rules of practice, it is essential to recognise the consequences of the second condition. In this scenario, a company your spouse owns or controls could fall under the Associated Company rules. As we will discuss later in this video, this can impact corporation tax rates and cash flow. There is also another vital factor to consider: companies in different tax jurisdictions that the same person/group of people control. Under HMRC regulations, it does not matter where the company is registered. Therefore, companies from other countries may unwittingly find themselves associated. Exclusions to the Associated Company rules. There are some situations where what may look like an associated company will not fall under the current rules. Exclusions include dormant companies, passive holding companies, lack of substantial commercial interdependence. The third exclusion is important, highlighting the difference between companies owned by the same person/group of people and their commercial interdependence. Consequently, not all companies owned by one person or group will be deemed associated. How might this impact corporation tax? When looking at company profitability, you will notice that the authorities refer to augmented profits. These are defined as total taxable company profits plus any exempt dividends from non-group companies. We will now look at the impact of associated company status on corporation tax and how this may impact cash flow. At the moment, there are three primary thresholds. Companies with profits less than £50,000 a year will be charged corporation tax at 19%. Companies with profits over £250,000 will be charged at 25%. Companies with profits between £50,000 and £250,000 will be charged at 25%, but can also claim marginal relief. Where there are associated companies, the thresholds are reduced, potentially increasing the tax liabilities of each company. Case study. It is probably better to show the consequences of associated company status in practical terms rather than focusing on the technical aspect. Scenario. Number of companies, 5. Corporate relationship, associated. Augmented profits for each company, £25,000. Where there are associated companies, the above thresholds are divided by the number of companies. In this situation, the thresholds would be rewritten as follows. Profits of less than £10,000 would be charged corporation tax at 19%. Profits of more than £50,000 would be charged at 25%. Those with profits between £10,000 and £50,000 would attract a 25% charge but can claim marginal relief. If we ignore the associated company status for a moment, on a standalone basis, each company would be charged corporation tax at 19%. 19% by £25,000 equals £4,750. Combined corporation tax liability, £23,750. However, in this case study, the companies are associated, so there will be an adjustment to their corporation tax rate. As profits are greater than the adjusted maximum rate for 19% corporation tax, the rate is increased to 25%, as you can see below. 25% times £25,000 equals £6,250. Combined corporation tax liability, £31,250. Calculating marginal relief. In this instance, individual company profits are above the adjusted lower tax band, but below the higher rate where there is no relief. Using the HMRC adjustment of 3/200ths, the profits of each company will be liable to corporation tax as follows. £25,000 profits at 25% corporation tax equals £6,250. Combined associated companies, £31,250. Adjustment calculation. 3/200ths multiplied by adjusted higher band minus the individual company profit equals marginal relief. 3/200ths by £50,000 minus £25,000 equals £375 marginal relief. Adjusted corporation tax liability, £6,250 minus £375 equals £5,875. Compare and contrast. If the 5 companies did not fall under the associated company status, their corporation tax would have been £4,750 individually, or a combined figure of £23,750. Taking into account the associated company status and ignoring corporation tax relief, the situation would have been as follows: £6,250 individually, or a combined figure of £31,250. This equates to an extra £1,500 per company, or an additional combined corporation tax figure of £7,500. If we take into account the tax relief available, the situation is a little more palatable. £5,875 individually, or a combined figure of £29,375. Even after the tax relief adjustment, the corporation tax liability still equates to an additional £1,125 per company, or a combined figure of £5,625. As you can imagine, the more associated companies there are, the more significant the reduction in the corporation tax thresholds and the higher the potential corporation tax liability. Large and very large companies. Where augmented profits are greater than £1.5 million and there are several associated companies, this can significantly impact company cash flow. Currently, if a company earns augmented profits of between £1.5 million and £20 million per annum, it is deemed large. Therefore, rather than paying corporation tax 9 months after the company's year end, the company would be liable to pay quarterly instalments on the 7th, 10th, 13th and 16th months following the start of the accounting period. Consider the following scenario. Number of associated companies, 2. Augmented annual profits, £1 million each. As standalone companies, they would not be deemed large by HMRC. However, if they were associated, they would, as this would halve the £1.5 million minimum definition of a large company down to £750,000 in annual profits. In this scenario, each company would need to pay quarterly instalments, as detailed earlier, which could have a potentially significant impact on cash flow. Companies with profits exceeding £20 million, deemed very large companies by HMRC, are also expected to pay tax every quarter. However, this begins 4 months earlier than those companies deemed large. The £20 million minimum profit to qualify for very large company status would be halved to £10 million with 2 associated companies and down to £2 million with 10 associated companies. It is not difficult to see how the combined effect of several associated companies might impact individual company tax payment plans. Corporation tax planning ahead. Before you start building your business empire, it is vital to appreciate the structure and the potential impact this could have on corporation tax rates and tax payment timetables. It is also crucial to consider businesses owned by spouses and connected parties or the same group of people. The impact can be significant even on relatively modest profits, but this will multiply where profits are in the hundreds of thousands or even millions of pounds. Associated companies and corporation tax. Summary. As ever, what on the surface may seem like a relatively simple topic can become rather complex when you look at it in more detail. We at Wilkins Southworth have the skills and experience to provide tailored advice when structuring your business interests. If you have any questions regarding associated companies and corporation tax, then please visit our website and leave a message. We will then get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.